And I think that the takeaway is that maybe the Federal Reserve is further away from yield curve control than people like myself may have thought. I thought the Fed was going to be moving towards that, and it seems to me that there's still some reservations about the benefits and some concerns that the Federal Reserve, unlike the Bank of Japan or unlike the Reserve Bank of Australia, who's implemented yield curve control, that the Federal Reserve would have to buy a lot more bonds, while the Bank of Japan and the RBA haven't. So I think that's the takeaway. That's the big takeaway from what the Fed said. But I think it's important to note that the Federal Reserve, before the Federal Reserve minutes came out, the dollar was already rebounding, and gold was already coming off. And then when the FOMC minutes came out, the dollar hesitated for a little bit, and then sold off, and then rallied again, extended its gains. And so I think that these corrective forces were already in play and were not triggered by the FOMC minutes. I think that we'll still be watching carefully what happens at Jackson Hole next week. That's the annual symposium. This time it'll be done virtually, where Fed officials and other central bankers talk about the issues of the day. And so we'll still be watching that closely to see any hints about what happens at the September FOMC meeting. Here's the concern really, is the Federal Reserve is in the middle of, the Treasury Department is in the middle of issuing lots of bonds. Early on in the crisis, it issued a lot of T-bills, and now it's going to roll those out to longer maturities. And so some people are concerned that all the supply is going to force up interest rates. And for the Federal Reserve to announce yield curve control, they're basically saying that what they're going to do is target interest rates besides Fed funds to keep interest rates low, despite this bulge in supply. But I think you're right that the Federal Reserve thinks that maybe there's more effective measures that they can take. One of them, for example, could be the average inflation target, which means that because we've undershot inflation, that the Federal Reserve won't raise interest rates just because we're approaching the 2% target. They would let inflation average 2%, which means after undershooting, they would allow some overshooting. I think that what they're hoping to do is to get the markets to do most of the heavy lifting and take the least amount of risk, and just part of this review of their policy framework, how to really understand what 2% inflation ought to mean. Because as you saw, as you've seen in the recent years, the Federal Reserve has really struggled, like other central banks, to achieve its inflation target. In fact, the Fed hasn't gotten its inflation target since 2012. And so if it continues to have sort of in this way, the Bank of Japan as well, they've had an inflation target, and when officials don't meet it, after a while, the officials lose some credibility. They were still vulnerable, and the one takeaway from those FOMC minutes is that the Fed staff, they're the ones who do the economic forecasting, that the Fed staff had become more concerned that the recovery was losing momentum before they met in July. So I think that the concern, of course, would be on the downside of the economy still, and especially now that some of those fiscal packages, like that $600 a week unemployment insurance, is run off, and we've got more outbreaks of the virus. I think that the risk would have to be on the downside of the economy. So some of the Fed's programs that they launched earlier on in the crisis, like those swap lines with foreign central banks, they're not needed as much anymore. And as they mature, the Fed's balance sheet shrinks. And so right now the Federal Reserve is buying about $80 billion worth of treasuries a month. And that's just enough to offset some of the recent unwinding of other programs. And so I think the Federal Reserve is going to have to do two things. One is to change the understanding about why they're buying assets. They're not buying assets like they were in the beginning to make sure the financial markets are working okay. They need to buy assets to help the economy recover. And that means also they might have to buy more bonds, more assets, so expand its balance sheet somewhat faster. I think in some ways you're right. 4 years ago, it looked like Hillary Clinton was going to win, and she did win the popular vote, but she lost this electoral college. And so I think people feel a little bit reserved, hesitant about betting too much, if you will, on what the polls say, especially these national polls. But if you look at the different markets, the volatility like the sort of a volatility curve. The market is expecting some heightened volatility in the last part of the year, and I think for good reason. I mean, in the U.S., because of the epidemic, there's this whole debate about the mail-in voting and absentee ballots, and what that means is that it's possible that we have the election on a Tuesday, and we don't know the results for several days afterwards. And that kind of uncertainty, given the high partisanship, that uncertainty would be probably be impactful on the markets as injecting more volatility. So I think that there's some danger of this, and I think the market's well aware of this. And we're now within a 3-month period, and the 3-month period is important for financial markets because that's where the liquidity is the best. That's sort of like our time horizon, if you will, for a lot of participants. And so I think now that we're within 3 months, I think we get through the, as you say, the Democratic convention this week, Republican convention next week, and I think the real campaign, as it were, kicks off after Labor Day. That would be the first week in September.